Good afternoon, everybody. Welcome to the American Enterprise Institute. My name is Andrew Biggs. I'm a resident scholar here at AEI, where I work on Social Security, retirement, and pension issues. We're very happy to have you all here today. I apologize for the fullness of the house, but I guess we've combined two interesting topics here today of Social Security and tax incentives for retirement savings. So in a sense, we're doubling up on the topics, and it seems doubling up on the attendance as well. But I thank you all for coming here today. Because we have a full plate in terms of subject matter, I'm going to keep my comments as short as I possibly can. I'll start by introducing our speakers today. Our key speaker today is Pete Brady, who's a senior economist in the Retirement and Investor Research Division of the Investment Company Institute, where his work focuses on pensions, retirement savings, and the taxation of capital income. Pete is the author of the new book, How America Supports Retirement, Challenging the Conventional Wisdom on Who Benefits. He'll be presenting some of the results from his work today. I believe we have complimentary copies of the book outside, and I recommend you all take one. Ask Pete for his autograph as well.
Double the value.
Our discussants today are really we have a great panel today. I'm really very happy that they've all offered to speak. Our first discussant today will be Bill Gale, who's the R.J. and Francis Miller Chair in Federal Economics Policy at the Brookings Institution, where his work focuses on tax policy, fiscal policy, pensions, and saving behavior. And following that, we'll have AEI's own Alan Viard, who's a resident scholar here at AEI, where he studies federal tax and budget policy. So again, I thank you all for coming. Pete, do you want to start out?
Sure.
Great.
Okay. Well, thanks, Andrew, and thanks to you and AEI for organizing and hosting the event, and thanks to for all of you coming out today. So let me get started. The study analyzes who benefits from the U.S. retirement system. What I mean by that is government programs that help workers accumulate resources for retirement. So there are many components to the U.S. retirement system. The main government program is the Social Security system. And for many households, retiree households, this is going to be their primary resource. However, many households will also, on top of Social Security, have resources that come from employer plans, both defined benefit and defined contribution, and IRAs. Matter of fact, if you look at the 2013 survey of consumer finances, and you focus on people age 55 to 64, about 73% of all those households and 81% of working households are going to either have benefits that they accrued in a defined benefit plan, assets in a defined contribution IRA plan, or some combination of the two. So what this study focuses on is estimating the benefits of that combination of programs and seeing how it varies across workers. Now, a lot of the motivation. The motivation for this study is that there's been several prominent proposals that would affect the tax treatment of employer plans and IRAs. They come from both sides of the aisle, but all of them would either restrict or change in a fundamental way tax deferral. Tax expenditure estimates are often invoked by those who are in favor of these proposals, not only the aggregate estimates, but increasingly distributional analysis. So most of the analysis on tax deferral typically is going to analyze tax deferral in isolation. What the goal of this research is to look at the combination of benefits from both Social Security and tax deferral and see how it varies across workers. So the hope is that this will provide some context for the existing research, but also illustrate how the two programs work together. Additionally, I'm going to challenge some of the conventional wisdom about tax deferral. Okay, so the very few studies analyze both tax deferral and Social Security together. The most notable exception are a series of papers by Sil Schieber. And they use different measures. The two strands of the literature use different measures of benefits. So in Social Security research, what they typically will look at is net benefit payments. That is the present discounted value of all the benefits you'll receive from Social Security minus the present discounted value of all the taxes you paid over your lifetime. in tax expenditure research is typically going to look at the change in tax liability, that is the tax expenditure, associated with tax deferral in a given year. So what this study's method is to both look at benefits over a worker's entire lifetime and also jointly estimate Social Security and tax deferral. Now, in addition, this is going to use this. I'm going to use the same measure to measure the benefits of both Social Security and deferral, which is a tax expenditure. So, what's the key finding of this exercise? Well, the benefits of the U.S. retirement system are progressive. What does that mean? Well, if the benefits of the combination Social Security and tax deferral as a percentage of each of individuals' lifetime earnings is going to be higher for lower earners than for higher earners. Now, it turns out, then what I do is I take the simulations that I needed to do to make that estimate and also illustrate why two widely held beliefs about tax deferral are actually incorrect. So what the simulations will show is that the higher earners, people with higher lifetime earnings, do benefit more from tax deferral. But the reason they benefit is not that they get more benefits on every dollar they defer, it's that they defer more dollars. The second issue is that what the simulations show is that far from providing an upside-down incentive to save, tax deferral actually equalizes the incentive to save. All right, so the plan for this talk is I'm going to explain how you estimate a tax expenditure, apply that method to the U.S. retirement system, show you the results, and then go on to the challenging the conventional wisdom. Okay, so a tax expenditure, which is any tax code provision that deviates from an idealized normal income tax structure. The way you estimate a tax expenditure is you're going to run two separate simulations. The first simulation is a simulation of the current tax code, and the second simulation changes just that one component, that one tax expenditure, and keeps all other parts of the tax code the same. And then to measure the benefits, to measure the tax expenditure, you take what your tax liability for an individual would be in the alternative simulation and subtract the tax liability under current law. That difference is the benefits they receive or the tax expenditure they receive. In addition to the tax expenditure, in addition to being estimated one at a time, are also static estimates. So what that means is that relative to the baseline simulation, we assume that no behavior changes in response to the tax law change. So this is the method that's typically used to measure the benefits of deferral, and I'm going to use this method to estimate the benefits of the complete system. So the first step, I should mention one thing. Tax deferral turns out to be a little bit harder to estimate than other tax expenditures. Why? Because with a deduction or exclusion, you're going to reduce tax liability in the year you take it, but you don't affect tax liability in any other year. With deferral, you do affect taxes in the current year, but you also affect it throughout the lifetime. So in particular, if you compare normal income tax treatment to tax deferral, it differs at 3 different points in time. So when typically under a normal income tax, if you wanted to invest part of your compensation, you would first that compensation would be subject to tax, and you would invest the after-tax amount into a taxable investment account. Then every year, as you gained interest or dividends or realized capital gains, you'd be taxed on that income. However, when you take it out, there typically would not be a tax because you've been taxed all the way along. What tax deferral does is that it excludes the compensation from your income, so you're not taxed on it in the year you earn it. It also excludes any investment returns on those contributions. And both of those things will reduce your tax rates, reduce your taxes paid. But then it has a third effect, which is when you take it out, the entire thing is subject to tax. So it's not that deferral looks a lot like an exclusion or deduction. It's not that it's either better or worse. It's just a lot different and a lot more complicated because you have to sum up all 3 effects. So let's get to the baseline simulation of current policy. Remember, I got to do current policy, and then I got to remove what I'm interested in and do an alternative. So I'm doing this with 6 representative workers. They all work conveniently for 35 years, so they all have the maximum number of years allowed in the Social Security calculation. They retire at their normal retirement age, and they have a range of earnings, which I'll explain a bit more in the next slide. So these people are born into the world with nothing but their human capital. There's no trust funds that come along with them. So all their income is going to be generated by their work. While they're working, they have wages, and also when they're retired, they're going to have Social Security benefits and tax deferral. I'm not going over all the assumptions, but one assumption I'm going to point out is that I'm going to assume that each one of these workers wants to maintain their standard of living. That is, replace their net income prior to retirement when they're in retirement. This is an important assumption because as you'll see in a few slides, Social Security replaces a different part of your pre-retirement earnings depending on what your lifetime earnings are. And so, although they have the same target, they're not going to have the same contribution behavior to the 401k because they're trying to hit the same target. Okay, so let me introduce you to 6 individuals I've spent a lot of time with lately and become rather attached to. As with all my friends, I refer to them by their inflation index average earnings while they're working. The main three series that I create are basically designed to represent someone with a high school average worker with a high school education, which is the yellow line, average worker with a bachelor's degree, blue line, and average worker with a graduate degree, the green line. Now I want that doesn't give me a whole lot of range in income, and I want to fill it in, and so I just take variations of those 3. One is half of what the high school worker makes. Another one is 1/3 higher than the typical person with a graduate degree. You might want to call them the successful person with a graduate degree. But one of the things I've learned over the past, 10 years is that the threshold for being rich is $250,000 a year. All right, so there's a big gap between that earner and a rich person, so I want to fill that in. However, primarily because I found it depressing to contemplate a 30-year-old making over $200,000 a year, what I did is I had them start out like my successful graduate school worker, and then hopefully through hard work and talent, rise through the ranks, and by the time they're 40, they're making twice as much as that worker. Okay, so the main point is we have a wide range of earnings. Now, what do these people do with all their earnings? Well, while they're working, they're going to pay income taxes, both federal and state. They pay Virginia income taxes because I pay Virginia income taxes. They're also born in 1966 because I was born in 1966. They then also will pay payroll taxes, and they will contribute to their 401k plan. Anything left over, I assume they eat, they consume, and that spending is what they have. So in retirement, what their goal is they're trying to maintain their spending, not their income, but their spending. And so I'm looking at a net replacement rate. All right, so they retire at age 67, and they live off of their Social Security and their 401k plan. So again, the important point about Social Security is that the benefit formula is very progressive. So it's designed to replace a higher percentage of pay for workers with low lifetime earnings. Now, the benefits, the actual dollar amounts actually go up with each earner. The more you earn, the more you get. It's just it goes up at a slower rate. Because of the differences in their replacement rates, even though they're all trying to get to the same point, they rely to different extents on their employer plans, their 401k. So they're all going to start contributing at different ages and contribute different amounts. Despite getting different shares from these 2 different sources, they all get, nearly all get to their replacement rate. So the top earner ends up not being able to get there because I'm giving everyone a standard 401k plan, 6% of matching 50% of pay up to 6%. And because of that, that individual is actually constrained by the employee contribution limits. And despite from the entire time I see him, from 32 to 66, they contribute the maximum, he can't quite get there. Okay. So again, this is going to be important important thing to remember and helps explain some of the results you'll see in a few minutes. But again, all of them have the same, they have much different compositions of income, but they all hit the same target replacement rate. And the main thing driving that is going to be the progressive benefit schedule that you have from Social Security. Okay, so now I got my baseline. What I'm first going to do as a comparison to some of the other studies out there is I'm going to look at the benefits tax deferral by itself. Okay, I don't want this to be my final estimate, but I just want to show you what it looks like. So how do I estimate it? Well, first I run a second simulation, and that simulation assumes that tax deferral is no longer allowed, but nothing else changes in the tax code. So what does that mean? Well, the workers still take the same amount of compensation they would have contributed to the 401k plan, but now they contribute to a taxable investment account. I also assume that since there's no change in behavior, that their consumption doesn't change, their net income doesn't change while they're working. So any additional taxes are paid for by penalty-free withdrawals from this taxable investment account. And so the entire impact of this is going to be felt by them in retirement. What's the benefit? Well, it's the taxes paid over the worker's lifetime in present discounted value in the alternative simulation minus the taxes paid in our baseline of current law. And that's going to be the benefit of deferral. So you can think about what I did is I took the total benefit that workers get over their lifetime and separated out to the portion of it that they accrue while they're working, and then also the portion of benefits they get while they're retired. So during their working career, tax deferral provides benefits because if you contribute to a taxable account, your taxes would go up a lot. So with tax deferral, it reduces taxes. And the benefits sort of go up with a pretty steady rate with the worker's earnings. However, what happens in retirement? Well, they get a negative benefit. What's a negative benefit? Their taxes are actually higher with deferral than it would have been with a taxable account. And the reason is with a taxable account, you pay a lot more taxes while you're working, but you would have them all paid. And so when you took withdrawals, less of the withdrawal would be taxed. So it actually increases taxes in retirement, offsetting the benefits. And so this is the result you have. Now, on the left is typically what a lot of policy discussions seem to be stuck at. So the benefits workers get while they're working. Now, the economic research doesn't do this, but policy discussions seem to be focused on that. And that's misleading because for the people who have the biggest benefits while they're working, they also pay a lot more taxes than they would have in retirement. So the benefits go up, it's flat over a range. All right, so, but my whole argument is that you shouldn't be looking at tax deferral in isolation. You want to look at the whole U.S. retirement system because the programs are actually designed to work together. Now I'm going to do the full system. Okay, so in this, my alternative simulation is that both tax deferral and Social Security are eliminated. So my treatment of tax deferral is just like my second simulation. What does it mean to eliminate Social Security? Well, I'm going to estimate it the same way I did for tax deferral. I'm going to assume that instead of taking 12.4% of pay and paying it in payroll taxes, you're going to take 12.4% of pay and put it into a taxable investment account. And then I'm going to compare how the difference between the current system with its taxes and benefits compares to a system where it was you accumulate on your own in an account. Okay, so I'm going to do a similar analysis as I did with tax deferral, but now I have another component that I want to split out, which is net benefit payments. So again, this is the typical measure the Social Security research will use as a lifetime benefit, and it's the present discounted value of benefits received minus the present discounted value of taxes you paid. What this shows is, and this is not all that different from any other research on this, is that the benefits are positive for the lowest earning worker, but they decline as income goes up. They actually reach a peak with the second highest earning worker, and that's because the highest earning worker, a lot of the extra income is actually not subject, it's above the cap, the Social Security cap, so it's not subject to tax and you don't get any benefits based on it. So the absolute penalty for they actually have larger negative net benefits measured in dollars, but it's smaller as a percentage of their income. But Social Security also ends up impacting income tax liability. So what happens to income tax liability if you eliminate both tax deferral and Social Security? The solid bars were just the estimates when we did tax deferral alone, and the total is the combination of the two. And what you see is actually this benefit's it's substantial, and for many workers is actually bigger than the benefits of tax deferral. And again, the basic intuition is if you took 12.4% of your pay and you put it in a taxable account, your taxes would go up a lot. Now it turns that there isn't much additional effect of eliminating Social Security on taxes in retirement, and that's the intuition behind that is that if you eliminate tax deferral, most people wouldn't pay a whole lot of taxes in retirement to begin with. So if you then also eliminate tax Social Security, it's not going to have much of an effect after that. So if you add up the three effects, this is the goal of the whole exercise was to get this number, which is an estimate of the benefits, again, as a percentage of each worker's lifetime total compensation in present value of the combination of the programs. And so you can see that the combination of both having a positive net benefit payments. And the lowest earning worker also gets a lot of income tax benefits, and it has pretty high benefits overall. Those decline, and then for the top 2 earners, there's a bit of a push up, but it's still below the earnings at the bottom end. So again, this is the result that on its own, tax deferral does benefit high-income workers proportionally more, but the combination of the 2 programs are progressive. Okay, so that's my main result, but I can now use the simulations to help illustrate why some conventional wisdom actually is incorrect. Okay, so the typical explanation of why, so again, in the simulations, higher earning workers do get more benefits from tax deferral over their lifetime. The common explanation of why this occurs has to do with marginal tax rates. So the typical explanation would be if someone in the 35% bracket puts $100 into an account, they get $35 worth of benefits, and if someone in the 15% bracket puts money into the account, they get a $15 benefit. Well, it turns out that's an excellent intuitive explanation of deferrals and deductions, deductions and exclusions, but it doesn't apply to tax deferrals. Because again, it's not just the upfront benefit, it's not just the deduction and exclusion up front, you have 3 different effects and you have to add them all together. What the simulation results show is that the higher earners benefit more, but again, it's not because they get more benefits on every dollar, it's because they put more dollars in. And in my model, I'm not saying in reality necessarily, but in my model, all my workers are all just trying to get to that replacement rate, and the reason higher income workers put more in is they get less from Social Security. They rely more on that. So, what this slide does is actually look at the marginal benefit calculation. So again, the argument is the reason that higher income get more is if they put another dollar in, they'll get a lot more benefits from tax deferral than a low income worker. So what this slide looks at is calculates the benefits, assuming that tax rates don't change over time. And the thought experiment is suppose all these workers put another dollar in at age 50, took it out at age 71, let's calculate what the benefits would be. And even if marginal tax rates are unchanged over time, it is true that the benefits do go up with the marginal tax rates, but it certainly doesn't move in lockstep with the marginal tax rate. So for the lowest earning worker, they have a marginal tax rate, their federal plus their state taxes of almost 20%, and they get benefits on that about 16 cents for putting an extra dollar in. For the highest earning worker, they have nearly double the marginal tax rate, but the benefits are only about a third higher. Matter of fact, for the top 4 earners, there's really not a whole lot of difference in the benefits, marginal benefits. Now, but what I will tell you is this calculation actually underestimates benefits for all of the workers. And the reason is that in the simulations, the marginal tax rates of all the workers are actually higher while they're working and contributing and lower when they're retired and making withdrawals. And if your tax rate declines, it actually increases the benefits of tax deferral. And so if you account for the differences, and I should also note that while everyone declines, the biggest declines happen to be on the bottom. Okay? And so if for these 6 workers, you calculate the marginal benefits, you actually see that the lower income workers on average tend to get more benefits on the extra dollar they put in than the higher income benefits. So again, the reason that the benefits go up with lifetime earnings is not more benefit per dollar, but more dollars being put in. Okay, the next thing is the typical, well, not typical, but an explanation that I find annoying is about why higher earners, about the current tax code, is that the incentives to save are upside down. Higher earners get more incentive to save than lower earners. Okay? What the simulation results show is that normal income tax treatment discourages savings, and by effectively taxing, regardless of your marginal tax rate, taxing all investment income at effectively a 0% rate, what tax deferral does is equalize the incentive to save. So let me explain this a bit more. What's the incentive to save? The incentive to save, if you save, that means you have to spend less today. It adds to 1. That's what it is. Okay, so what's the benefit of spending less today is I can spend more tomorrow. And it's the terms of that trade-off that is the incentive to save. If I put $1 in, how much do I get back? Okay, so I'm actually cheating a little bit on this presentation. I have a very complicated calculation using the simulations. This you could do at home in an Excel spreadsheet, and I encourage you all to do that. So what this says is, suppose I have someone's putting in how much, so they have $1,000 of compensation, you have two workers, and they're trying to decide, should I consume, should I spend it today, or should I wait and put it and invest it for 20 years and earn a 6% rate of return? So the question is, what's the incentive to save for both these workers? In the 0% marginal tax rate, the choices are, well, I don't have a tax, so I could take the full $1,000 of compensation and I could spend it today. Or I can put the full $1,000 in a taxable investment account, but because I don't pay any taxes, it would grow tax-free 6% a year. I'd have 3207 left over. And so my incentive to save is that for every dollar I give up today, in 20 years, I can spend $3.21. That's the incentive to save. How about for the 25% marginal tax rate worker? Well, they can't take the whole $1,000 out and spend it because they have to pay taxes. So they can only take $750 and spend it. Or they can take that $750, put it in a taxable account, pay tax on the investment, well, in this case, interest every year. And then after 20 years, they'd have 1809, if I'm reading it correctly. So what's the trade-off there? They get $2.41. So the normal income tax structure gives a lower incentive to save to higher income workers. Now let's go to tax deferral. Well, it turns out for the 0% worker, the trade-offs are exactly the same, $3.21. But now we have a different story. So now for consumption, if they want to consume it today, they take it out, pay the taxes, got $750. Or they take the whole $1,000, they put it into this tax deferred account. After 20 years, how much will they have? Well, they have zero rate on it, so it'd be 3207. Now they can take that 3207 and spend it, but they can't take all of it because they owe about a little over $800 in tax. So what they get out after they pay the tax is $2465. Yeah, these don't look too similar, but it turns out if you divide, you have the same incentive. If I give up $1 of spending today, I get $3.21. So what tax deferral does is effectively tax everyone at a zero rate and equalize the incentives to save. So the book has a lot more in it, but I had 22 minutes, so I figured I'd stop there. And hopefully, we can discuss some of the other issues. And again, the main findings are, if you look at the combination of Social Security and tax deferral, the two programs, the benefits of the two programs are progressive. And if you ask, well, why do high-income workers get more benefits from tax deferral? It's not the bang for the buck. It's not they get more benefits on every dollar they put away. They put away a lot more dollars. And that's largely driven by the Social Security benefit schedule. And finally, as we've just shown, the incentive to save isn't upside down. It tends to equalize the incentive to save. Thank you.
Thanks very much, Pete. Next up is Bill Gale from Brookings.
All right. Did you take that?
I don't want Bill to talk.
Which one are we? All right. All right, thank you. I thank AEI for hosting this event. Thank Andrew for inviting me, and thank Pete for a really interesting and comprehensive piece of work. It must be painful to summarize a 200-plus page book in 20 minutes because I have a pretty good sense of how much work went into that. So I appreciate the work and the input, and I'll try to skim the surface in my comments because the only thing harder than summarizing a 200-page book in 20 minutes is discussing the summary in 20 minutes. So the paper has two new analytic results that I think merit a lot of attention. One is the analysis of the joint distribution of Social Security and the private retirement system. And the conclusions there are that retirement savings subsidies are regressive, Social Security is progressive, and the combined effect basically is progressive with a minor exception. And then the second major analytical result is analysis of incentives to save, and this issue about whether incentives to save are upside down. And I think the paper does a good job of showing that they are not upside down when you take into account the deferral aspect of things, as Pete said. Then there's, after those two analytical points, there's a sort of a wide-ranging discussion of a bunch of points that I found less convincing than the analytical stuff. Pete makes 4 points. One is a distributional analysis of tax expenditures, which he just did, is not relevant. Second, it argues TR 86 did not take into account the distributional effects. I think this might be a semantic issue, but Alan will talk about this more too. Third, he talks about alternatives to tax deferral. And fourth, he talks about or alludes to the saving effect of retirement savings subsidies. So I'll try to touch on each of those too. But I want to, the meat of this is the two analytical results. I want to talk mainly about the first one, maybe a little bit about the second one. So as Pete described, you got 6 representative workers. They differ by their wage level, their Social Security replacement rate, their Social Security contributions as a share of income because their wages differ. All 6 of them retire at the same age, and they all aim for the same replacement ratio in retirement. Of course, given their different Social Security situations and given that they're aiming for the same replacement ratio, they contribute different amounts to 401ks. So they contribute, higher income contributes sooner, they contribute more, and that makes perfect sense. To simplify, there are no other assets, and I just came from a budget meeting this morning with the chair of the House Budget Committee, so I just want to clarify, in the paper, people receive scheduled benefits for Social Security, not payable benefits. There's a pretty big difference. So the cases are considered. One is he changes 401ks to a taxable investment account, and the second case changes both 401ks and Social Security to a taxable investment account. So interesting counterfactuals. The outcome of interest is how does the present discounted value of lifetime benefits under these changes vary by income level as a ratio scaled by lifetime earnings. So how does the percent of, how do benefits as a share of lifetime earnings vary with the income level? And as I said, there are 3 results. This is taken right from figure 4 in the paper. The tax-deferred saving system, the private system, what I'll call the 401k system, but is meant to be an approximation of the whole retirement savings system, is regressive. Specifically, the benefits as a share of lifetime earnings go up as lifetime earnings go up. The classic definition of regressive. Social Security is the opposite, except for this overly ambitious guy who's making $234K. But it's a progressive system. The lifetime benefits as a share of lifetime earnings fall as lifetime earnings rise. And then the net effect, the combination, is mostly a progressive system. There's this anomaly quite right at the top, but basically, the combination is a progressive system. Okay, so that's the basic result. It's really important to emphasize there has not been a lot of integrated analysis of Social Security and the retirement system. So this is a serious contribution and one we should welcome. So I have 4 comments. A couple of comments are not criticisms or critiques, they're just comments. And the first one is just a comment. And that is, this is not actually an analysis of the retirement savings system. The retirement savings system itself is messy. It has people working partial careers, starting careers, stopping to have kids, coming back in it. It has, people get disabled, so on. People retire at different ages. People start contributing. This is a stylized representation of the retirement system. And that's fine. This is just a framing comment, not a criticism. Just something to think about in terms of understanding the system. We're not actually examining the details of the 401k or the Social Security system as they play out in the population. We're taking 6 stylized workers, marching them through the Social Security and 401k system under stylized assumptions. Okay, so just in terms of framing. The second comment is actually a compliment. Steve emphasized, sorry, I was up till 1:30 last night. Pete emphasizes the overall progressivity of the retirement system versus this notion of micro progressivity. If you've ever worked in public finance, you know this is a really important point. It doesn't matter that each individual component of the system be progressive or favor the poor over the rich or whatever you want. What matters is the whole system, not just the tax system, but the whole tax and spending system. And so This comes up, for example, in analysis of the carbon tax, analysis of the value-added tax, where there are lots of good reasons to do those things. However, those interventions are regressive, according to conventional definitions, and so you would want to take offsetting measures somewhere else if you cared about the regressivity, but the regressivity itself shouldn't stop you from undertaking those measures. The same thing applies in the retirement system. You want to look at the whole system, the regressive effects of the whole system, or the progressive effects of the whole system. So having said that, I think that's really important. It's also important to note this does not give a free pass to the regressive part or the progressive part. We still want to analyze the components and understand how to make them better. And I have this comment of Michael Jordan and Stacey King. You might be asking yourself, who is Stacey King? Well, Stacey King is the guy that scored 1 point the night that Michael Jordan scored 69 points. And Stacey King went into the press conference after the game and said, "I'll always remember this as the night that Michael Jordan and I combined to score 70 points." And so you definitely want to examine the components, not just the whole thing. All right, so now we get into a little more technical stuff. The definition of progressivity, the classic definition, applies to a tax system, and it means the average tax rate goes up as income goes up. Okay, when you start putting benefits in there, what it means is the net benefit rate goes down as income goes up. That is, net benefits as a share of income go down as income rises. I hope to convince you here that that is a very weak condition for considering whether a policy is good or not. And so I want to use this extremely realistic example where there are two people in the economy. One of them earns $1 and the other one earns $100 million. And there's the retirement system, and the retirement system gives $1 of benefit to the $1 worker and $50 million of benefits to the $100 million worker. Okay? That is a progressive system because the average benefit rate falls as income rises. The average benefit rate is 100% for the $1 worker. It's 50% for the $100 million worker. Okay, so the average benefit rates fall as income rises. But of course, obviously, it gives more in absolute terms to the high-income person than the low-income person. So I'm not sure anyone would defend this system, but this is a progressive system. So it's evidence that this is a very weak criteria. All right, now you might think this is ludicrous, but this is exactly what, this is not exactly, qualitatively, this is what Pete finds for the retirement system. It's the same effect. The average benefit ratio declines as income rises, but the absolute benefit rises as income rises. And so this is the system that, so it's, I can't read it from here, it's like 1,200 versus 7,500 as opposed to 1 million versus 50 million, but qualitatively it's the same thing. So then we have to decide whether we're looking at percentage gains or absolute gains as to which is the better measure. And then the language gets tricky here, very subtle. I was talking to Pete about this earlier. There's a statement in the paper that low-income earners benefit more than high-income earners do. And I was saying, I don't think that's right in this example. I think, you know, if I were a high-income guy, I would not give up my benefit for the benefit that the low-income guy gets. But then Pete mentioned to me that in the paper, in the 2 sentences before that, he mentions benefit more as a percentage of lifetime earnings, okay, which is a correct statement. Whereas if you just say benefit more, to me that sounds like an absolute benefit. So the lesson here is just that we have to be real careful. It's very easy to slide into statements that can be taken out of context. Now, I would argue that in the hypothetical system and in the actual system that Pete estimates the well-off people are benefiting more than low-income households, even though the average benefit ratio is higher. I'm sorry, the net benefit ratio is higher for low-income households than high-income households. So it's a matter of judgment, but it affects how we talk about who benefits more from this stuff. All right, last point, the analysis may overstate the progressivity of the retirement system. There are just several assumptions that struck me here is that in the literature on the adequacy of saving, low and middle income households tend to be the ones that save inadequately, sort of not the lowest one, but like the 25th to the 60th percentile tend to be the ones. Their social security replacement rate goes down, but they're not contributing a lot in the pension system. So if those people are undersaving, they're getting less benefit from the retirement system than the analysis assumes, because the analysis assumes no one undersaves. All right. Likewise, low and middle income households don't always have access to 401ks. If you look at eligibility for 401ks, it rises sharply with income. So if they don't have access to 401ks, they can't be participating on the retirement system. The analysis assumes everyone has access to 401ks all the time. So it might overstate the benefits that low and middle income households are getting. At the high end, again, the analysis assumes everyone saves adequately for retirement, but no more. But you have examples of people using 401ks or IRAs generally as tax sheltering schemes. Mitt Romney and his famous $100 million IRA is a good example, but retirement plans are also useful for estate planning, and they can be passed. The balance can be deferred indefinitely, basically, if it gets passed from generation to generation. So I think the analysis might overstate the benefits for low and middle income households of the current retirement system and understate the benefits for high income households from the current retirement system. All right, so let's move to the not upside down issue. I think Pete nailed this issue, that normally for a tax expenditure, the argument is, say it's a charitable contribution, someone in a 39%, who faces a 39% tax rate is only giving up 61 cents per dollar of contribution. Someone in the 0 or 10% rate who itemizes is giving up 90 cents per dollar of contribution. That's right, and that applies to anything that's an exclusion or a deduction, but doesn't describe tax deferral because you have to pay taxes on it at the end. And Pete shows that basically the incentive, the net incentive is pretty, I'd be happy to call that constant across income groups. And the driving force here is that low-income households, although they face a lower tax rate when they contribute, they face a much lower tax rate when they take the money out, most of them being at a 0 income tax rate in retirement. So I think this is an important contribution, and I'll leave it at that. Then the rest of the paper, I think, loses its focus. And I'm talking about the paper, I have not read the book. I just read the paper. Loses focus somewhat. There's a discussion about are tax expenditure, distribution analysis of tax expenditures relevant? And I was kind of confused about this because I thought I just read a distribution analysis of tax expenditures. And Pete kind of, sort of like this Pete agonistes here, going back and forth about whether, who kindly concludes that provided it's understood that what the estimates represent, they provide potentially useful information to tax policy analysts. So I'll go with that. If you understand what the estimates mean, they're potentially useful. That seems hard to argue with. The second question is, did TRA 86 take the distributional effects of tax expenditures into account? Pete argues that they didn't. This may just be a semantic issue in that I feel that they did because they tried to be distributionally neutral. So anything that they did with one hand, they had to offset with the other hand. Now you could say, well, they're not. Let me just leave that. It's semantic. I think there's agreement that TRA 86 tried to be distributionally neutral, and so I think it's semantic whether they realized that when they did tax expenditures they needed to offset it, or whether they came back to it at the end. But it seems to me that they did take the distributional effects into account because they wanted it to be distributionally neutral. Alan's going to talk about this more, though, and we'll explain all of this. More on TR 86. Pete has a couple of critiques of other policies, which I'll skip. maybe we can talk about them in the discussion. Lastly, I want to talk about the effects of these programs on saving. Whether they're pro-growth depends on whether they boost saving. And there's a big literature on that. I've contributed to, other people have. I want to focus just on the high-income groups because I think the results are pretty straightforward there. So the standard line is saving incentives, of course, give people incentive to save. But, you know, they also give people incentives to shelter funds by moving from taxable into tax-deferred accounts. So, I mean, if we called them tax shelter incentives, we would focus on the tax shelter side of it. If we call them saving incentives, we tend to focus on the savings side. But it's important to realize there are both of these effects are there, both of these incentives, rather, are there. And so what happens ultimately is an empirical question. And again, when you focus on there's a big controversial literature about this generally, but when you focus on high-income households, it turns out there's very little evidence that these shelters, these incentives, raise net saving, raise net wealth accumulation among high-income households. There's a classic paper by Peter Brady and Wise that presents a lot of evidence on 401ks and saving generally, but when they break it up by income group, the one group they find where there's not a net saving effect is the top group, people 75 and higher, 75,000 and higher. That was back in 1991 when 75,000 was real income. In work I did with Eric Engen, we showed that most 401k balances are held by high-income households, but the net saving effect of those contributions by high-income households is lower, substantially, potentially much lower than the net saving effect of contributions by low-income households. And then there's this new paper, well, not new, but recent paper by Raj Shetty and others looking at the Danish system, where they showed that when Denmark reduced the subsidy rate by 14 percentage points for retirement contributions made by high-income households, virtually all of the reduced contributions to retirement accounts showed up as increased forms of other saving. It was literally 99% they found. So this is important because, come back to this Michael Jordan, Stacey King example, the justification for retirement saving subsidies, and especially at the retirement saving subsidies at the high end, can't be, well, we give benefits to low-income workers through Social Security, so if we should give them to high-income workers through retirement saving subsidies. There's got to be some positive impact of those saving subsidies. If there's no net saving effect among high-income households from retirement saving incentives, then it doesn't matter how well Social Security helps low-income households. It only matters we're making cash transfers to high-income households via the retirement system. And so I think the right analysis of the tax expenditure for retirement saving focuses on the net saving effect. If they're not increasing net saving, the subsidies are not increasing net saving, then it's hard to justify why they exist, since they cost the Treasury money. And I think the argument that they're raising saving among high-income households is particularly difficult to make. It's particularly difficult to find evidence in favor of that. So none of this contradicts the notion, none of this last point contradicts the notion of the various distributional effects of Social Security retirement system, but it serves to say that so I guess I'm agreeing here with Pete, that distributional effects are not enough, and that if there's no net saving effect, there's no reason to have these subsidies. So let me stop there and turn it over to Alan.
Thank you, Bill. Next up is AEI's Alan Viard.
Thank you. Thank you all for being here, and thanks, Peter. Thanks, Andrew, for organizing this. This is a very interesting paper. I think the combination of tax and Social Security is particularly appealing to me. I've long been interested in both topics, so to have a paper here that discusses each of them is really a great opportunity. Pete, I think, takes some effective blows against the conventional wisdom, and I think he very powerfully presented those points. It's interesting, by the way, isn't it? I think that in any paper that discusses the conventional wisdom, you always conclude that the conventional wisdom is wrong. There's never been a paper that I've seen which says the conventional wisdom is right. So that's Pete has stayed with that pattern here. But I think he does show that the conventional wisdom is off point on a number of key issues. So the outline of what I'm going to do in my 17 minutes, if I'm able to, is to give an overview of the contributions and limitations of the study, discuss this issue of whether tax preferences should be evaluated based on distributional concerns, which Bill talked about. Pete did not mention here, but it is in his study, and I'm taking the same position he does on that. And so the fact that I'm talking about it and he didn't, I mean, I think maybe that's appropriate. And then, given the conclusions on that point, how should we evaluate retirement policy? And just to offer a few brief comments on that. So the overview of the contributions and limitations, I've actually put one slide on each, but I don't want to suggest that they're actually equal. The contributions of the study far outweigh any limitations, and so want to make that clear up front. The signal contribution here to begin with, of course, is examining both taxes and Social Security and the interaction between the two, and that is a relatively rare perspective and a vitally important one. Also, the emphasis on present value computations, which is relatively well known, I think, in the economics community, but as Pete said, not really as much in the policy community, also is at least as critical. It's just absolutely imperative that you look at what happens when the money comes out as well as what happens when the money goes in. The stylized examples do have some limitations, as Bill mentioned and as I'll mention, but they also do have some great strengths. I thought it really made clear the insights about how both the level of tax rates and the life cycle path of tax rates matter. We often assume, just for convenience or simplicity, that people are in the same tax bracket when they take the money out as when they put it in. We sort of know that's probably not going to be true, but it's not all that common for people to really look at, well, what might that pattern really be? And how does that change things? And so I thought that really offered some insights. Pete also did affirm, at least in the study, but not in his remarks, really the standard optimal tax view on how distributional concerns should be or should not be taken into account. And he didn't fully explain it, which I think is a reasonable choice. I'm going to try to explain it, which maybe will be a mistake, but you be the judge. You be the judge. And then Pete also did critique some of the current policy proposals that have been made and really got down into the details of those. So what are the limitations? Well, as Bill mentioned, it does assume uniform replacement rate targets, and therefore in the study, the variations in savings rates across these 6 workers are generally attributed to how generous Social Security is. And I think, as Bill mentioned, and I know Pete hedged a bit in his presentation here, obviously that's one big factor that's very important, but there's other things going on too. The replacement targets are likely to vary in practice among the different income groups, as Bill mentioned. So, and it also does not discuss the impact of the retirement accounts on net saving. And Bill, of course, alluded to that a bit in his remarks. And then the last thing, I don't really know whether you count this as a limitation or not. Maybe it's just, well, I'm not sure. Pete provides these great results on the distributional analysis of these tax expenditures, but then points out that we really shouldn't be looking at that in evaluating those expenditures, which I think is largely right. And so he's in this position of saying, yeah, well, here are these results, but this is not really that important. So I don't know if that's a limitation or not, but I think it's a very candid statement. Policymakers are going to keep looking at the distribution, so it's still a valid and vital contribution that he did tabulate those. So let me go into an explanation of sort of what the standard optimal tax view is. When you're looking at different tax preferences and you find that one of them goes to rich people, one of them goes to poor people, should that sway your evaluation of which one you like? Obviously, there's other factors you will take into account as well, but is that something that should matter? And if so, in what sense and why or why not? So optimal tax theory has really kind of addressed this question, not exactly tax preferences, that's not the way it's phrased, but instead varying rates across different goods. Should you tax food at a lower or higher rate than you tax yachts, for example? How should necessities and luxuries be treated? And under some interesting conditions or assumptions, The economic optimal tax literature says that distributional concerns should not affect your relative tax rates on goods, that you wouldn't tax yachts at a higher rate than food simply because the yachts are bought by rich people, and you also wouldn't tax the food at higher rates than the yachts, but instead would tax them at the same rate. Now, one key assumption here, to lapse into economics jargon just for a second, is separability. We'll assume that there's no goods here that play a special role in helping you work or that play a special role in helping you not work, but instead they're all just kind of neutral on that front. So what the standard theory says then is that when deciding these relative tax rates on goods, deciding whether you want to tax yachts or food at a higher rate, you should ignore distributional concerns, the question of whether it's rich or poor, and also the labor supply effects that are triggered by those distributional effects. And so that's something I'll get to in a minute. And this is true no matter whether you're Bernie Sanders or Barry Goldwater or whoever, whether you're a fierce opponent of inequality or someone who likes inequality, this conclusion should hold for all of you. So the reason is if we look at the choice, you might think at a moment, well, okay, I would like to tax the luxuries more than the necessities. Let's put a tax on those yachts because it's bought by rich people and they can more easily afford to bear the tax, which is obviously absolutely true. And that is an advantage of taxing the yachts at a heavier rate. It's a real advantage, and you might view it as a big advantage. But taxing a luxury instead of a necessity increases work disincentives by a larger amount. That the yacht tax dollar for dollar will create a bigger work disincentive because it's a luxury, the propensity to spend on it is higher relative to the average amount of these things that are being bought than would be a necessity. A necessity, if you bought the same amount, regardless of how much income you had, that wouldn't affect your work incentive to tax it because none of your extra work dollar would be going to buy the necessity, but it would be going to buy the luxury. And so there's a disadvantage from taxing the yachts at a higher rate because you've got a bigger work disincentive. There's another disadvantage as well, which is that it also screws up whether people buy food or buy yachts. That's just a gratuitous interference with their being able to choose the goods that are best for them. And that last disadvantage is the tiebreaker, in a sense, that this distributional gain of putting the taxes on the people who can best afford to pay it, that's a great goal, but you can attain it with less inefficiency by just making your tax rate schedule more progressive. Raise the top rate, lower the bottom rate. And that avoids that third point. It doesn't screw up the choice between those two goods. Now, someone else might step forward and say, well, actually, I'm tempted to tax the necessities at a higher rate because I understand that will reduce the work disincentive. It'll be more efficient in that respect. And then someone says, well, yes, but there is a disadvantage on that. You're putting a tax on people who can't afford it. So that's certainly a drawback. And then there's another disadvantage, which is that it screws up your choice between goods, this time in the opposite direction. It makes you buy the yachts instead of buy the food. And so once again, the same point holds that the efficiency gain you're looking for is great, but you can attain it with less distributional disadvantage, putting less burden on the poor, just by making the tax rate schedule less progressive. So optimal tax theory says that when you're deciding whether to tax yachts or food at different rates or the same rate, that you should ignore this rich versus poor consideration and instead set rates based on micro factors. You start with a presumption, oh, they should be taxed equally, and then you say, well, okay, but one of them might have a positive outside effect on other people. Maybe taxing one of them is simpler. Maybe there's some issue of treating fairly people who are two people are at the same income level. Maybe there's some paternalistic reason to steer people towards one of the items instead of the other. And if that separability thing wasn't true, you'd also want to put a higher tax rate on goods that facilitate leisure, a lower rate on the ones that facilitate work, like childcare. And does that mean that you ignore distribution? Oh, absolutely not. It means you address that through your rate schedule, and you make it as progressive as you need to make it in order to take care of that issue. Well, there is a caveat to this. One case where you would want to consider distribution in setting these relative tax rates, and that is if you think that the current rate schedule is wrong, that it's either too progressive or not progressive enough, and if you can alter these relative tax rates, but you're not able to change that progressivity of the schedule. And so in that case, you'd like to change the progressivity, but you can't, so you screw around with the tax rates on goods instead. So if you think you need more progressivity, you do tax the yacht at a higher rate than food. And if you think that you need more labor supply, you do the opposite. And again, you'd prefer to adjust the rate schedule, but for some reason, you supposedly can't. It is interesting, though, that in public discussion, we always do tend to assume that a tax preference for the poor, all else equal, is better than a tax preference for the rich. Why is that? Well, one possibility is from the slide we just saw, maybe everybody thinks that the tax rate schedule is not progressive enough, and for some reason we can't change that, but we can change these tax preferences. That's possible. Another possibility, I think, is that people may not realize the effect that tax preferences have on work disincentives. They don't realize that the preferences that are more for luxuries would tend to have better labor supply effects. I do think that second explanation is almost certainly right, but it doesn't rule out the first one because they're not mutually exclusive. So with that behind us, how is it then we would go about evaluating retirement tax policy? I mean, how would we decide whether these 401k and deferral provisions are good or bad? And I could just going to offer some very brief thoughts on that. So based on this conclusion, the distribution is largely irrelevant. So when Pete said these numbers that I went to so much trouble to compute is not what you really should look at, he's right, and we really shouldn't look at them. But it's great that he did them because other people are going to look at them. So we really shouldn't, we really shouldn't look at the retirement provisions distribution alone. But we also shouldn't look at its combined distribution with Social Security either, because both of those we could really offset by adjusting the rate schedule. Now, there is one point, though, where distribution may be relevant. If we thought that saving by the poor was more socially beneficial than saving by middle income or high income people, because it made people more self-sufficient and such not, I mean, that would be a reason why we might want to provide tax incentives for saving by the poor and not tax incentives for saving by other groups. So if we try to make our tax system as neutral as possible, how do these provisions tie in? Well, the income tax today, for the reasons that Pete explained, treats current consumption better than saving. If you save, you pay tax on your return to saving. You're worse off than if you consume today in your tax treatment. And so that's a tilted playing field that we're starting with. What these so-called preferences do is they treat the retirement accounts more or less the same as the current consumption. Take them away from the harsh tax treatment that ordinary saving gets and give them the better tax treatment that you would get with current consumption. So is that a step towards neutrality or away from it? Well, it's a mixed bag. It is greater neutrality between the retirement accounts and the current consumption because those are now being treated similarly. But of course, it's less neutral between the retirement accounts and ordinary saving because the retirement accounts get tax breaks that other saving doesn't. So it's kind of what economists would call a second best problem. So how do we think about addressing that? Well, it's the issue that Bill homed in on towards the end of his remarks. If the retirement accounts are largely a substitute for current consumption, in other words, if they really do make people save more, then the preferences are probably a good thing because we're making the tax treatment of retirement accounts similar to the current consumption that they are substituting for. But it would be less desirable if the retirement accounts are just substitutes for other saving that people would do. You just shuffle your money out of other accounts into the tax accounts, tax-preferred accounts. So the statistical evidence is, I think, mixed, and Bill is a major contributor to this, and he summarized it, and I think, presented some relatively, discouraging results for these preferences. The study doesn't discuss this, but it would have been, another lengthy addition to the study, so that's reasonable. And then I think that the other issue is this: even if you do decide, well, these tax saving preferences for retirement, they're not that great, maybe we should scale them back. Even if you decide that, you really need to be careful in thinking about how to do it, because it's really easy to come up with some idea about how to scale them back that may sound good at first glance, and yet the specific proposals are often complex and distortionary and really treat similar things differently for no good reason. And so Pete looks at some of the proposals that have been made in the current debate and sketches out some of the drawbacks that they have. So my final takeaway on this, I guess, is I think that it's wrong for the income tax system to treat ordinary saving worse than current consumption. In other words, I really believe that consumption taxation is a better tax system. If we did decide to end these so-called tax preferences, we'd really be extending this unjustified, unfavorable treatment that we already give to ordinary saving, extending it to the retirement accounts that we currently spare it from it. And so we'd actually be moving further away from what I consider as the ideal. And so I worry that that might undermine support for an eventual reform of moving towards consumption taxation. Thank you.
Thanks very much, Alan. I'm going to give Pete a couple minutes to respond to anything he'd like to respond to before we go to Q&A.
Thanks much. So I think the first thing I want to, well, maybe the first thing I should tackle is why I make my arguments. So certainly if I would believe if I went out and said, you know, you really shouldn't be looking at distributional analysis, I might get criticism of course you don't want to look at it, and you don't like the results. That is not the reason. And so I do think there's an important contribution of the first part of the paper, which is if I use the exact same criteria, which has been used to judge tax deferral as highly regressive, and I apply it to the entire system, it's actually progressive. All right, so if that's the standard you want to use, that standard it shows that it's not a problem. So, but my main point is that the focus over the past, say, 10 years on distribution analysis of tax expenditures, I find maddening. And let me see if I can succinctly describe to you why. So there is a distinction between distributional analysis of the entire income tax and distributional analysis of tax expenditure estimates. So let's take a hypothetical. Let's say Congress raised the top marginal tax rate, just hypothetically. And then I compare a distributional analysis of the entire income tax before and after that change. What would I see? Well, you'd see that higher income earners bear more of the burden of the income tax, and their taxes have gone up. Okay, so I can imagine a headline might be, Congress raises taxes on rich. What would I find if I compared distributional analysis of tax expenditures before and after that change? Well, what I'd find is high-income earners now are receiving a lot more benefits from a whole host of tax expenditures, right? Because if you, and so what would that headline be? That would be Congress expands tax breaks for the rich. And my point is, I find the first analysis to be of some value. I don't find the second analysis to be very helpful. So that's why I make the distinction. And I'm making the distinction that in past times when we looked at doing a comprehensive reform of the income tax, we really haven't focused on that aspect of tax expenditures. Now we have focused on tax expenditures, but not because of distributional effect. So, and I think it is exactly just a semantic point, and I thought I made it perfectly clear what I was talking about in that section. What I'm arguing is that in the 86 and actually in most of these previous reforms, the reason people wanted to get rid of tax expenditures, often described as lowering rates and broadening the base, was not because it would end up with a more progressive tax system. Ideally, what I would think you should do in any comprehensive reform is you'd set some targets for what you want the progressivity to be, and then you'd have multiple packages of all sorts of changes that would hit that target, and then you would compare them not on their progressivity, because they're all hitting the target, but on their other aspects, horizontal equity, economic efficiency, and simplicity. And so the last part of the paper is to make that point and then have a brief discussion. Obviously, it is not a comprehensive discussion. It was already at 210 pages. But to bring up some points on those other issues where, in fact, if you look at some of the proposals, they would actually they would reduce horizontal equity. They would be awfully complex and in a lot of ways not be as good. So why don't I stop there? And there's some other issues, but we can discuss.
Thank you very much, Pete. The conventional wisdom is that a moderator should just keep his mouth shut and go straight to Q&As, particularly when we're pushed for time. And in this case, the conventional wisdom is right. So I am going to restrain myself from asking a question. Do we have microphones out here for Q&A? Thank you very much. If you could just wait till the mic comes to you, state your name if you like, give your affiliation. Please make questions short and end with a question mark.
Yeah, Olive Hopkins. I know that Social Security is progressive, but what you didn't mention was that poorer people tend to die earlier, so they don't get as much money from the Social Security in the long run. Is that right?
Well, in my book, I do mention it. And so let me explain it. So on the point of the representativeness of my sample, as attached as I've become to these workers, if an attractive new microsimulation model came along that I could use, I'm not saying I wouldn't consider it. So I'm not doing this because I think it's better than a microsimulation model. I don't happen to have one. However, I also do think there are benefits of this type of analysis in conjunction with microsimulation models, because sometimes I see the results of the microsimulation model and I have no idea what's driving the results, and sometimes it's hard to tease out. This one, I'm not claiming that my 6 people, by God, represent all Americans. The unisex, never married, no children people that I'm presenting. Obviously, that's not my argument. But I think it can be complementary to microsimulation models estimates, because I can lay out exactly what's happening. And I think there's a lot of complexity that in this debate that about how the benefits work that people aren't taking into account. So here's my discussion of that point. I obviously agree that that's an important issue, but I leave out a lot of things in my simulations. So, for example, I am counting OSDI taxes and counting OASDI taxes and OAS benefits. So what am I leaving out? The benefits of the disability system. So that would work in the opposite way. Now, I'm not saying they would magically offset each other. However, a study that did use a microsimulation model and tried to account for this, for both the difference in mortality, but also the benefits that people get from a disability, was done by CBO in 2006. And what it found is that, yes, the difference in mortality offset some of the progressivity of the benefit schedule, but then when you put the benefits of disability, that went very much to the low end, and the whole system was very progressive. So I'm not discounting that fact. I'm just saying, I'm not dealing with it here, but I think there's reasons to think that the results are representative with that caveat.
Another question? If you don't ask one, I will. Well, here I go then. One thing that struck me is you're basically doing a static analysis. And with a lot of policy, in a sense, you could say that's okay. What we're trying to do is just have neutrality between saving consumption. On the other hand, in general, when people are thinking about these policies, they're thinking, well, we're going to pass a policy, and people are going to do something in a response to it. If you look at the low end on the Social Security, I think generally we'd agree they probably won't. They're not responding to the transfers from Social Security by lowering saving on their own. Once you get up to middle and higher income people, they probably are offsetting the Social Security. With the very high income, the question is, are they saving more in 401ks or IRAs in response to tax incentives? How do these behavioral sort of issues come into play when you're thinking about this as policy?
Well, and that's one of the reasons why I don't think distributional analysis of tax expenditure estimates are terribly useful. So again, my goal is to do a tax expenditure estimate. I actually make some of those criticisms in the paper as an illustration. I think particularly the Social Security estimate, really illustrates, well, gee, that's kind of weird. We shouldn't do that. And I agree with them. But those apply to all the tax expenditure estimates. They all don't account for behavior. You can say, well, if you got rid of the employer plans, people would save less. I think that's something that may happen, okay, particularly if employer plans disband. But that's not a part of a tax expenditure estimate. So what has frustrated me is, for my time at Treasury, I think, well, quite honestly, I don't know if the staff was terribly interested in these, because I'm not sure they thought they were terribly useful. But what is interesting, we do revenue estimates, and so if there is a proposal to change the law, revenue estimates do account for behavior, and we'd have to think of all these issues and model that out. And then if we analyze, that type of analysis, I think that's analytically useful, or at least that, was part of my day job, so I hope it's useful. But I just don't think, so yes, I absolutely agree with all those things. But it's not that you can take the existing tax expenditure estimates, fix a few of those factors, and then go on. You'd have to do it fundamentally thorough job of it, and that's not what these do. And again, my point in the book is, look, I think the aggregate tax expenditures provide some useful information as long as you know what they are. I mean, I look at them and give a sense, but I can adjust in my head that they're not accounting for behavior. And the main problem I have with them is I think people overstate what they mean. And again, I find that has some value, but the distributional stuff I don't find very valuable.
Yes, sir.
Hi, I'm Bruce Klein, and now I have a mic, like you did.
You're Bruce Klein.
And I'm from Pension Policy Center. And what I'd like to know is, I thought you did a very interesting analysis. I really appreciated your profiles, because profiles are really important, and people can really relate to it. And to write a book using profiles helps lay people relate to policy. Now, what I'd like to know is, did you use a differential savings rate for high-income people? Because my work and my studies indicate that high-income people are able to get investments that pay higher returns because of two reasons. One, they have access to different investments, and two, they're less risk-averse than low-income people.
So, again, let me explain a few things that actually came up in the discussion. So I am modeling a 401k plan that has 3% employer matches and employee contributions. Part of my motivation for that is a lot of the proposals that want to change the taxation seem to be focused on 401k plans, and in particularly employee contributions to 401k plans seem to be particularly thought of as not good. So that was, since most of the proposals had to do with it, that's what I was modeling. So one of the issues, which is valid, is that maybe people can get put money away in other ways. I know a little bit about the tax law. I'd have to say that's true. People can put money in a lot of ways that most analysis of this issue don't even understand. But a lot of the Treasury staff or a lot of the lawyers might tell you some things. And I'm a bit frustrated, quite honestly, by all the focus on employee contributions to 401ks. So I will admit that you could put more away, and I think we should probably learn how to do that. Now, as far as a higher rate of return, I assume that might have something to do with $100 million in an IRA for Mitt Romney, but I have absolutely no idea how he did it. I'm certainly nowhere near that, so I have no idea how that is accomplished. I do know from my expert estimation using an Excel spreadsheet that he didn't put $6,000 a year in an IRA or $18,000 in a 401k or even $53,000 in a 401k and pick really good mutual funds. I'm pretty sure that's not how it happened. If we're upset about the $100 million account and we take it out on the plain vanilla 401k saver who's just trying to provide retirement, I don't think that's a good reaction. But I think it's a legitimate point to at least contemplate that a gap in the tax base of that large you'd have to have some justification for, and we should investigate it. But I have absolutely no idea about higher rate of return. I mean, my assumption is that I'm looking at, I think in any forward looking, particularly when revenue is involved, you use a risk-free discount rate to project things forward. And if you think that you should use a higher rate of return because these things earn more, I'm willing to accept it, but then these things don't cost that much actually if that's the case, because they become like a margin account for the government and they're a good deal. So I always assume the rate of return is equal to the discount rate in these projections.
Other questions? Yes, sir.
See, one of the differences in perspective between Pete and Bill, it seemed to me to be on looking at the deferral and the effect on taxes there versus look at the other end on distribution and the taxation. When money's taken out in retirement, and do we have a clear picture of, in terms of government revenue, revenue to the government over 10, 20, 30, et cetera, year period, of how those two balance out? Because it seems to me that might be pertinent to people on the Hill and policymakers. What's the real cost of on the deferral side when you offset it with what happens on the distribution side of things. Does that make sense, the question?
I think so. And if your answer is what good of a handle do we have on revenues over a 30 or 40-year period, so yeah, I have some doubts about that. Our models are actually cross-sectional models, and were first designed for a 2-year forecast, and then we stretch them to 5 and 10. So 30, I have some issue. I don't know. My guess, we don't know. I will say one of the things that struck me about doing this, something I never really thought deeply about, but struck me from these simulations, is that in the simulation where you remove tax deferral, very few people, even high wage earners are paying taxes in retirement. Now, obviously, these people don't have trust funds. They're born with the human capital. There's lots of people with lots of sources of income. But if you're a worker, even a very successful worker, that was one of the outcomes. And I think one of the considerations is not only sort of the perception of generational equity, but actually generational equity, because we really budget on an annual basis. And you have the situation, particularly as at least CBO thinks expenditures on the elderly are going up and having no revenue coming in. Now, to be fair, certainly to Bill isn't that I know of saying get rid of everything, but it just was something that I hadn't really thought fully about. Of a lot of this is a tax benefit, okay, because a tax deferred is a tax saved, but there is also a lot of intertemporal shifting of tax payments, which probably should be considered.
Yeah, I guess part of it is just, does the government really lose revenue significantly on the deferral when you do it to a period that includes the distribution phase and not just the accumulation phase? Yeah, so this is an issue that comes up when I edit documents, for example, that others have written. Tax deferral has a benefit. Otherwise, people wouldn't want to do it. And the only point I make about tax deferral is that it's different from an exclusion or deduction. I don't mean it's better or worse. So, like if you asked me to compare my two children, I wouldn't say one's better or worse. They're just different. Okay, and so it is a tax preference, but involves 3 effects, and it's extremely complicated. But the argument that the money you pay on at the end pays back all the taxes you lost in nominal terms, that might work, but not in present discounted value, unless you get a really high rate of return on them. And, again, I think that's a problematic assumption to forecast, but it is possible in reality if people got really high returns. That offsets some of the costs, but these things cost money. That's not my argument. It's just different than a deferral.
John, yes.
I have a question about how Social Security is treated. And Bill raised this point that, of course, nobody knows what will happen about Social Security reform, but we do know that you can't finance the current benefits with the current tax rate. And so how would, if the Social Security reform was like, last time and benefits were cut and taxes were raised, just for example, nobody knows, how would that affect your results?
Well, it obviously would depend on what the exact proposal is. So I have actually, the first time I used these people was actually a paper I wrote in 2006, and I guess was published 2008 or whatever. And in there I do, I wasn't looking at taxes, I was looking at replacement rates and what the impact of those would be. And depending on how you cut the benefits, it'll have considerably different effects. If it's across the board, it's going to have certain effects. If it's phased in, most of the discussions I hear are not. The current law is actually it's across the board. That's settled, but I don't hear many people contemplating that would be a good thing. And my guess is, whatever you do to close the gap, it's going to hurt a lot of people. They're either going to have higher Social Security taxes, so they have less disposable income, or they'll have lower benefits, so they got to save more to hit the same rate. But I don't. I may be wrong, but if it's across the board, it's going to affect the returns for everybody proportionally. I guess the benefit's bigger, so I guess the absolute benefit cut would be bigger. I haven't really thought that all the way through. My main point is that actually, So a lot of arguments are the reason that low-income people aren't saving is because they're not foresighted or they're making mistakes or they're irrational. Partly what my estimates say is that, well, even if they were all trying for the same replacement rate, you would still get this disparity because of the Social Security system. I'm not denying that there may be other disparities, but even if you don't account those, you get this pattern that we actually see.
Yes, sir, in the back.
Hi, John Topoleski, Congressional Research Service. So you kind of alluded to kind of my question. So do your results speak kind of in some way speak to what we see out there in terms of coverage, private sector coverage?
Yeah, so I actually, while I recognize these are representative workers, I'm actually amazed at how it corresponds with the data I look at. So, for example, my lowest earning worker has very low annual earnings, but I did an exercise where Social Security released earnings records for Social Security recipients in 2003. So I looked at 67-year-old Social Security recipients in 2003. Well, more correctly, Stephen did. But and then adjusting for projected wage growth, that person on a lifetime earnings basis would be at about the 33rd percentile of the lifetime earnings distribution. So none of my workers are actually really low from a lifetime earnings perspective because they all work 35 years. I actually think, we see, so 27% of all households don't have accumulations as they're approaching retirement. And we also know that younger people are, older workers and higher income workers tend to be much more likely to be covered by a plan. So it's not random who's covered by a plan and who isn't. So, and if you can even tab the SCF by education. And certainly someone at low income, they may have a plan. It may not be a lot, but in my simulations, they don't have a lot. And if you actually looked at, say, people with a graduate degree and what they have accumulated, it's a whole lot more. So I actually think, I'm not claiming I have replicated the economy with 6 people, but I'm saying that to me, they don't look all that inconsistent to the data that I look at.
I think we have time for one more question. Yes, ma'am.
Hi, my name's Christina Fitzpatrick from AARP. And Pete, I'm wondering if you can respond to what Bill was saying at the end of his presentation about how these tax incentives at the high end aren't actually incentivizing new savings, and so that maybe that affects how we think about them and how relevant they are, how useful they are.
Okay, so if I was going to take the U.S. employer plan system and backward engineer it and try to figure out what the people designed it were trying to do, and assuming Congress has intentions is always dangerous, but we've had tax deferral, it's not a new thing in the tax code. It was formally put in the tax code in 1921, so it's been around a while. Now, if I thought the most important thing for this policy to achieve would be to increase net national savings, and I was of the view that I don't want to attribute anything to Bill he doesn't accept, but perhaps views similar to Bill on the fact that people may not respond to taxes, and I want to increase national savings, I would run a budget surplus, and that would increase national savings. And if I was more of the opinion of Alan, that people are very responsive to these things and they're important, I would implement a consumption tax. So if my only goal was to do that, this is obviously a second best, it's not the first. But I think what we have is we have a Social Security system. What is that? It's a mandatory pension. Everyone's got to put in, has a progressive benefit. So I think what the goal of our retirement system is we have a mandatory system, and then we have a voluntary system that can supplement it, and particularly because the benefit schedule, it's the people who are going to want to use that the most are people who get a low replacement for Social Security. Obviously, if you limit the amount you can put into these things, my guess is it's going to have less of an effect on high-income people because they may want to save more than the limits. So that seems to me as a cost of the system, and why would we do it? I think there are reasons to do it, and I go through some explanations. I think it's important to figure out on net across everybody if it has an impact on savings. But I certainly, if that was my only goal, I would suggest different policies. And I think it's actually remarkably successful at getting people to retirement. The combination of Social Security plus some money, for low income, it may not be much, but something. I think it's actually worked quite well. But that's obviously open to debate. And my book is mainly about framing the debate. I'm not saying that if you do fundamental return of the reform of the income tax, that you should look at everything except for tax deferral. That ought to be off the table. That's not my argument. My argument, if you want to restrict tax deferral, it wouldn't be because it makes the tax code more progressive. It's because to hit whatever target I'm getting at, I'd like that better than, say, a package that had less deferral and lower marginal tax rates. That's the trade-off, and it's a legitimate conversation to have, and I don't claim to have all the answers. My main thing was saying this is really not the issue.
Well, we've reached 2 o'clock. Thank you all for coming. And let's have a hand for our 3 panelists today, Pete, Bill, and Alan.